Kessan. You know, for a lot of people, just hearing that word, the Japanese term for year-end accounting, can cause a little bit of stress. It sounds super complicated, really intense, and frankly, like something you'd rather just avoid. But what if I told you it's not nearly as scary as it sounds? Okay, let's just dive right in and break this thing down.
And this right here, this is the whole secret. Our source material absolutely nails it. Kessan isn't about learning some brand new secret type of accounting. Nope. It's just the culmination of all the small, daily entries you've been making all year long. It's all about organizing and finalizing, not inventing something new. So here's the thing you've got to remember. Closing isn't difficult. Really. The best way to think about it is like tidying up your house at the end of a long week. All year, you're making these little entries. At the end of the year, you just have to go back, check your work, fix any little mistakes, and make a few standard tweaks to make sure everything lines up perfectly.
Okay, so if it's just tidying up, where do we even begin? Well, the first big job is to get a really honest picture of your assets. I mean, what does the business actually own, and what is it all worth, right on the last day of the fiscal year? And we're going to start with one of the most basic things, your inventory.
This whole process is called tanarashi, which is basically a physical inventory count. And what you're seeing here is the standard journal entry to get our books to match reality. It's kind of like a two-step shuffle. First, we take our starting inventory and move its value over to an expense account. Then, we record the new value of the inventory we have left as an asset. It's a clever little move that makes sure our cost of goods sold for the year only reflects what we actually sold.
And get this, here's a fantastic little trick to remember that journal entry. In Japanese, the accounts are shire for purchases and kurikoshi shohin for merchandise inventory. So some brilliant accountant came up with this little saying, shikuri kurishi. It perfectly matches the debit and credit order. So simple, but wow, does it work.
Okay, so we know we need to record the value of whatever inventory we have left. But how do we actually calculate that number? Especially when we've been buying the same product at different prices all year long. Which price do we use?
And that leads us to a really important decision, our valuation method. Now, for the Level 3 bookkeeping exam in Japan, there are two you really need to know. First up is FIFO, or first in, first out. It's exactly what it sounds like. You assume you sell your oldest stuff first. Think of a grocery store pushing the older milk to the front. The other method is the moving average. With this one, you calculate a new average cost for your items every single time you make a new purchase. It's a little more math, but it really smooths out those price fluctuations.
Let's make this real with an example from our source. So we start the year with 10 units. We buy more at different prices, we sell some here and there. By the end of the year, we've got 12 units left on the shelf. Our job? Figure out what those 12 units are worth using both of our methods.
All right, first up, FIFO. Using that method, our ending inventory is valued at 1,340 yen. So how do we get that? Easy. FIFO means first in, first out. So the stuff we have left must be the newest stuff we bought. We take all 10 units from that last purchase in August at 110 yen each. That's 1,100. We still need 2 more units to get to 12, so we take those from the next most recent purchase in June, which were 120 yen each, add it all up, and boom, 1,340.
But now, what happens if we use the moving average method? We get a totally different answer, 1,305 yen. So why the difference? Because with this method, after every single purchase, we were calculating a new blended average cost per unit. So the cost of what we sold was constantly being updated. It's a much smoother approach and, as you can see, it can definitely change the financial picture.
And all this math doesn't just happen on a napkin. As you can see here, it's all formally tracked in something called a merchandise ledger, or shohin aridakacho. This ledger is the official record. It shows every single purchase, every sale, and the running balance, giving you a crystal clear history of your inventory.
Okay, so counting physical boxes is one thing. But what about assets you can't touch, like the money your customers owe you? That's your accounts receivable. And let's be real, there's always a chance some of those customers aren't going to pay. So to keep our books honest, we have to make another adjustment. We create something called an allowance for doubtful accounts to basically estimate and account for that potential loss before it even happens. It's all about being realistic.
All right, we've got our assets valued correctly. Check. Let's move on to step 2, which is all about timing. This is super important. We have to make sure that our revenues and expenses are recorded in the period they actually belong to, not just whenever cash happens to move.
Here's a perfect example. Let's say in December you pay a big fee for a loan guarantee, but that guarantee actually covers the next year. Well, it wouldn't be right to count that as an expense for this year, would it? So we make an adjustment. We temporarily park that cost in an asset account called prepaid expenses. The next year, when we're actually getting the benefit, we'll move it over and call it a proper expense.
And of course, this works the other way around too. Imagine your business year ends in March, but you don't get the electricity bill for March until sometime in April. You still use that electricity in March, right? So the expense belongs in March. We handle this by recording an accrued expense. We're basically recognizing the cost before we've even paid for it, pulling it back into the right time period. Now, it is worth mentioning that our source says for smaller amounts, a lot of companies just skip this to keep things simple.
Now, these little adjustments for prepaid and accrued expenses aren't just random rules. They're all based on one of the biggest ideas in accounting, the accrual basis, or haseshugi. And the whole idea is that we record things when they happen, not when the cash changes hands. This gives you a way more accurate picture of how your company is actually doing.
So let's move on to our third and final step, organizing the really big numbers. This is where we tackle things like long-term assets and, yep, you guessed it, everyone's favorite topic, taxes. When your company buys a huge big-ticket item, like a building or a new truck, it just wouldn't make sense to write off the entire cost as an expense in the first year. Instead, what we do is we spread that cost out over the asset's useful life. And that yearly slice of the costs, that's called depreciation, or genka shokyaku. Just think of it as the piece of that asset's value you used up during the year. Okay, let's talk consumption tax. As you can see here, there are basically two ways to handle it. The method on the left, tax exclusive, is a lot more detailed. All year, you track the tax you pay versus the tax you collect in totally separate accounts. Then at year end, you figure out the difference. The one on the right, tax inclusive, is much simpler. You just lump the tax right in with your revenue or expense. It's less work day to day for sure, but the tax-exclusive method gives you a much clearer view of your tax situation at any given moment.
And finally, we get to the last major entry, corporate income taxes. Once you've done all your math and figured out your profit for the year, you then have to calculate all the different corporate, prefectural, and city taxes you owe on that profit. This gets recorded as one final expense, hojinzei to, right before you get to your final net income.
So we've gone through all these adjustments, inventory, timing, depreciation, taxes, but why? Why do we do all this? It's not just about following some boring rules. It's about creating a document that tells a story. Your financial statement, your Kessan show, is your company's official statement to the world about how you did.
And this quote from our source really brings it all home. The ultimate goal here isn't just to make a set of numbers that only your accountant can understand. The point is to create a report that the business owner, the manager, can look at, actually explain, and truly be convinced by. It's a tool for real understanding. So once all those journal entries are done and the books are closed, that's when the real work actually begins. You see, Kessan isn't just about closing the door on the past year. It's about opening a window into the future. It gives you the information you need to ask the single most important question. What story do these numbers tell about our business this year?